Welcome. I'm getting lots of calls. What's the impact of the new tax laws on my income taxes? So, to get you a feel for what the impact might be for your particular income, we've developed this little presentation, Tax Rates and Phase-Outs for 2013. So we're going to have three different salary levels to look at. $250,000, $450,000, and $700,000. And these will be just salaries. No other income will be taken into account. That just makes it too complicated. More assumptions. Married with 2 children, so 4 exemptions. Property taxes of $10,000, mortgage interest of $25,000, charitable contributions of $5,000, and all state income taxes paid within the tax year. Hope you're staying with me. It'll get interesting a little later. Case number 1, $250,000 of salary. What happens to you in 2013 that's different than 2012? Nothing. You pay the same amount of taxes. The phase-outs for itemized deductions and exemptions start at $250,000, and there's no tax rate increase at this level. Case number 2, $450,000 of salary. There's an increase of taxes of about $4,000, or a 4% increase. Not as dramatic as you might expect, but where does that come from? Since tax rates don't increase until you hit an income over $450,000, most all of this is due to the phase-outs, and 0.9% of the salary over $250,000 gets hit with that high income health insurance tax. $700,000 salary. Now, what happens? There's an increase of about $25,000 of income taxes, or 14%. And this $25,000 is just federal income taxes. The tax rates account for about $11,500. So the increase from 35% to 39.6. The high income hospital insurance tax accounts for about $4,000, and the phase-outs account for the other $9,500. So the phase-outs have almost as much impact as the tax rate increases. So what's the marginal taxes that you're paying on the difference between the $450,000 and the $700,000 between federal and California? The difference is about $120,000, or 48% of every dollar over $450 is going to income taxes. That's a big deal. So how do you fight back? What do? We'll talk about 4 quick things, and then in our next segment we'll go into more detail. Item number 1, make less of the wrong kind of income. Notice my assumptions, I had it all being salary. If you're a subchapter S corporation, minimize your salary, increase your subchapter S distribution. That distribution is not subject to the high income hospital insurance tax. Enhanced retirement contributions. This is probably the single biggest thing you can do. With that high income tax bracket that you're in, the value of those increased retirement plan contributions is huge. Defined benefit plans can get you an extra $100,000, $200,000, in some cases an extra $300,000 a year of extra retirement plan contributions, which translates into tax deductions, which translates into more savings. 3, a wonderful opportunity for expanding your practice, buying new equipment, and making improvements to your space. There's an additional, the rate this year of these immediate deductions is $500,000. You have to remember the state only allows $25,000, so you have this federal state difference, but that's still a very meaningful number. And one last thing, think about employing your children. The difference between their tax bracket and your tax bracket is huge, and you can get some nice income tax rate arbitrage there. That's it for now. We'll look to see you on the next segment, where we get more into detail about how to save more taxes.